Morning, friends. Worry is like a fire which burns you, and the worry of money, the tension of money is a very serious one. You will realize it only when you have some serious disease where large amount of money is required for treatment and you don't have money with you, no savings, no insurance, then you can't sleep. You have to beg from others, or you have to sell your property, and your life becomes a hell. Therefore, we must be financially free in order to face such a situation. Friend, if you want to achieve financial freedom at any time in your life, you must understand the behavior of money, how the money works, how it earns for you. Then only you can be financially free by making prudent investment. Friend, I am Ramchandra and you are watching Prayas, a channel which is fully dedicated for development of your personality. If I talk of personality, if you don't understand financial matters, if your financial intelligence is weak, if your economic intelligence is weak, your personality cannot be strong. You cannot be effective. You cannot become financially free. Therefore, I have brought a series of videos on this subject, and this is the fourth video of that series. In the first video, I discussed how you can achieve financial freedom before even attaining the age of 35. In the second video, I discussed what 5 things are important which you must understand well before you can invest your money prudently. In the third video, I discussed the magic of compounding, which rewards for your patience. And in today's video, I am going to discuss the economics of money, the behavior of money, what is the flow of money, how it earns for you. Therefore, please see this video to the end so that you can understand it. Now I am going to discuss, after this video, I am going to discuss individual investment opportunities like fixed deposits, equity shares, debentures, and other mode of investments one by one, so that you can understand nut and bolts of these options and take appropriate decision. Now I have a discussion forum which you can join. I take live classes. I direct personality development program which you can attend, and your economic condition will not be a hurdle. For details, you can check description box, click certain links, see the content, visit our website, see the content there, and then decide how you can take help from me or I can help you. Now friend, let us discuss this particular subject, the behavior of money, the flow of money, the economics of money. Friend, you are aware that certain individuals, certain families, certain institutions in which government is included have surplus. That means their expenditure is less than their earning. They earn more than they spend. So they have surplus which can be invested. Now as an individual or family, you can give some donations also, against which you don't expect any return. It is for charity, which everybody should do. But mostly, such people will like that their savings should be invested prudently so that they can improve their financial health. They can achieve financial freedom. As against such individuals and institutions, there are certain individuals or families or institutions, government included, who are having deficit condition. That means their expenditure is more than their earning. So they require money from others to bridge this gap. And I can tell you that most of the developing countries have this type of deficit and they bridge it through loans. Now, the money flows from those who have surplus to those who have deficit. It can flow directly or it can flow indirectly through financial middleman. Now these financial middlemen are very important because they become a medium of flow. Now how this medium works becomes very, very important. Now how much your money will earn for you will depend the usage of that money and terms and conditions on which the money has been invested. For example, if you have given money to bank in form of fixed deposit or your money is lying in the saving account, so depending upon the withdrawal pattern etc., bank is able to guess that how much money they have which they can invest or give loan to others. So they can give loan to individuals, loan to businesses. If they give loan to individuals and businesses, there is a terms and condition of loan, that how much interest they will charge. Now suppose they are giving you 7% interest on your fixed deposit per annum, and if they have lended money to individual or institutions at the rate of 12%, so they are earning a markup of 5%. Now this 5% becomes their source of income. This margin finances all their expenditure and they earn money out of it, they earn profit and they serve their shareholders. Of course they charge some banking charges, etc., miscellaneous income is there, but the primary income is from interest. And if this bank is investing some part of that money in some equity share also, so they can earn more also, but they sustain more risk also. Now, suppose you have given your money for investment in some equity shares. Now here I will like to say that suppose a business entity has deficit, so it can bridge this deficit in two ways. Either it can take loan from bank or other financial institutions, or it can take loan directly from public in form of company deposits, etc., company bonds, or it can sell its share. So you hold a share in the company in lieu of that money. So in that fashion also you get money and bridge the deficit. Now, if you have given loan to the company directly or through bank, maybe if you give this money directly to some company through their company deposit scheme or bond, you may get 1 or 2% higher interest, because bank was earning 5% out of that 5%. Some part company will retain as a profit and some part it will pass on to you. So you may get, let us say if bank is giving 12% loan at 12%, so maybe they give you 10%. So bank is giving you 7%, company will give you 10%, so you get 3% extra. But the risk is you are going directly. You must understand the company and its credibility before you invest like this directly. Now, the moot question is, because you have given fixed return type of investment, there is a commitment, you will not get more than that. That is the upper limit you will get. And there is a chance of default that they may not be able to return your loan or pay your interest also if their financial position is very bad. So it is not that the fixed deposit and others are totally secured. Of course, they are secured up to 5 lakhs per individual, per account, per bank. That is under credit guarantee scheme. But beyond that, there is no guarantee. And this guarantee is not available if you invest directly into some company, bond, etc. But if you invest in equity share of a company, either you directly purchase share or you purchase share through mutual fund, through some asset management company. Of course, if the business will do well, it can give you dividend which can be higher than the interest rate which you will get in a FD or direct investment in debt. And if it is not doing well, you may get even less, or even you can get zero return, or even your capital can also evaporate. So that is a type of risk you take. So friend, it depends that at what terms and conditions you are investing your savings. So that will determine what money will earn for you, what is its uses. Now the second very important thing is that financial intermediary or middleman institutions like banks, non-banking finance companies, asset management companies which are managing mutual fund, insurance companies, stock brokers, stock exchanges, they are all working to serve the financial market. They become medium between those who have money and those who don't have. So how they work also is very important so far your earning is concerned. So if they work professionally, if they take interest in your interest, they are professional, they invest prudently, maybe you are able to get more income. So friend, money will earn for you provided you invest prudently, understanding where you are investing, what is the terms and conditions, and what precaution you are taking. If you are not diversifying your risk, like you can take a mutual fund which has got debt and equity both in this, so equity part is risky and debt part is less risky. So even if the share market goes down, your portfolio will not go so much down because of debt, which has got a fixed, stable return. You can include even gold in that, real estate in that, multi-asset fund you can invest in. So overall stability can be maintained. So friend, in conclusion, I would like to tell you that you must understand the dynamics of money, the flow of money, the behavior of money, the behavior of middleman if you want to invest in a prudent manner and achieve financial freedom as early as possible. Now friend, in further video now I am going to discuss individual investment options, their pros and cons. So I will request you to be with me on this channel so that you can get full knowledge about investment and protect your financial interest and become financially free. Friend, before I take a leave, as usual, I will request you that health is wealth. If you are not fit mentally and physically, you cannot increase your earning, you cannot become financially free. So please take care of your health by keeping away from negative things, taking a healthy diet, adopting healthy lifestyle, doing yoga, meditation, exercise, etc. And most importantly, please improve yourself every day. And in this process, you will improve yourself, improve your skills, increase your earnings, and obtain financial freedom at the earliest. And this channel is going to become your partner in this. Therefore, please be with us, see our videos, give your comments, suggest topic on which I should make video for you, and I will certainly try to do that. Friend, I am grateful to you that you are with me throughout this video, and I hope that you have got something out of it. If it is so, please like and share and subscribe. Thank you very much.